Well, the recent rate rally had us wondering if maybe the U.S. could be at risk for a credit downgrade. For more, let's bring in Phil Luck, director of the economics program at the Center for Strategic and International Studies. He was also deputy chief economist. I almost gave you a demotion for the U.S. Department of State under President Biden. Philip, great to have you with us.
Great to be here.
Before we get into the credit downgrade, I mean, I'm wondering how you think this action makes market participants around the world think differently, if at all, about the United States and about our credit if the Treasury is intervening right now.
Yeah, I mean, to the point that earlier panelists discussed, Treasury can clearly buy lower rates for a day or a day and a half, but clearly the fundamentals, the market disagrees with the secretary about what the fundamentals are, and I would happen to agree with the market here. I would also say that, to your other point, this is clearly a pattern. This is not an isolated incident now. We've seen sort of a pattern, whether it be the yen purchases or this or earlier last year. There's a clearly interventionist Treasury here, and part of the issue here is the way they think they need to be interventionist, right? So I think this really could create pause for market participants.
How do you think this will make it more difficult, perhaps, for Kevin Warsh? I mean, Kevin Warsh had clearly said that he wanted the Fed to step out of it and to let the market sort of, have a pure message from the markets. And here we have an interventionist Treasury who's buying on the long end, issuing on the short end, and really distorting the whole curve.
Yeah, exactly. And this is, I think this is a bit of a bipartisan shift away and towards a more interventionist Treasury. But this is, exactly the type of activity that was criticized by Bessent when Secretary Yellen took it on. I think this is really, it's a shift away. And I think this makes it obviously much more complicated for Warsh. Again, markets are really looking for clear signals here, in part because of what was just said, which is, if this keeps going, the math just kind of doesn't add up, right? We've doubled our debt in over the last 10 years or so. That almost every single quarter over that period we've been growing as an economy. If you look at the immigration policy of this administration, that puts a brake on the long-term growth of the U.S. economy as well. So, look, 30-year bonds are a bet on the growth and prosperity of the U.S. economy in the long term. We're doing a lot to sort of, have barnacles on the side of that growth.
Hey, Phil, this is not a new occurrence, but it's something that, keeps popping up a little bit. When you think of, Treasury Secretary Bessent, he's obviously a market participant, and now he has a lot of tools in his toolbox that maybe he didn't have when he was at a hedge fund. But when you think about like Microsoft as a credit, investment grade, it's got a higher credit rating than the United States of America. What sort of pressure does that put on the buying of treasuries and certainly, long-term credit when you have the ability to invest in things like that, for all intents and purposes, are well situated, as far as the economy, as far as, their kind of footprint as it relates to, AI and such?
Yeah, absolutely. And the other point I would say is, look, if the U.S. economy was just a company and had its balance sheet, I think its credit rating would be quite a bit worse, right? So it's, even in that sense, I would say, look, that's another aspect of this is not only does the Treasury sort of have this really huge demand, it's going to be publishing a lot of paper, that the market's going to have to soak up. So are private markets, right? We're seeing this huge increase in sort of issuance from the private sector as well. So, that really also is going to put pressure on the Treasury market. And that makes sense. We should be getting capital to its most effective use. If the U.S. government and the Federal Reserve really thinks, and the Treasury thinks that's government debt, it's going to have to pay for it.
So I'll get back to the question that we started this interview with. I mean, do you think that the U.S. is now in jeopardy of a credit rating downgrade from one of the major three agencies? Because of the mounting fiscal pressures, obviously there's not much bipartisanship anywhere in the country at this point.
Yeah, I'm much more worried about sort of just the market reaction than any rating agency right now. I mean, I think for sure, look, the fundamentals of our fiscal depth, our discipline are not good. And so that's certainly, I wouldn't begrudge that sort of assessment. But again, I think the broader issue here, and taking this from sort of a foreign policy and national security standpoint, look, the national security, economic security is a big discussion these days about supply chain resilience, all these things. And often what we're doing is we're going to pay for those things by borrowing a lot of money. And what I want to point out here is that there's a lot of lack of resilience and fragility coming in from being that indebted and being in a position where you really could have a lot of issues if we see a downgrade, which again, may very well be warranted.